Hello, everyone. Joe Mass here. It's another edition of Stay Calm and Carry On. So, I know our last video was a little longer. I would love to talk to you for the next 3 or 4 hours, but I'm going to try to keep this within 10 minutes. So, if you have questions on any of the slides, please give us a call and we'll be happy to go over those with you. So, let's get going. There I am again, my smiling face. And what we're going to cover today is just a real quick update on the COVID-19. And I'm not going to go into the medical facts. I'm really going to talk to you about how it affects your portfolios and what we're looking for from the financial aspect. And then we'll talk about the markets. Okay. So this is probably hard to read on your screen, so you can blow it up. But this is just my Bloomberg terminal lifetime tracking of the different momentum in recovery rates, increasing and decreasing. And so I won't go over all the numbers other than we're hoping to see the market recover once we've hit an apex of the recoveries and the deaths and all the carnage that's going on with the COVID-19. So as that improves, we expect the market to be ahead of the recovery because the market's always looking forward. So we're always paying attention to the numbers because this will hopefully give us the tell of when the market might turn. Now, we've had a great run up last week. We'll talk about that. A lot of people are wondering if we're at the bottom or not. We'll talk about that. But this is how we track live data. Here's a recovery spread with China and Italy and the United States. And so as you can see, China has recovered. This green bar, this is the daily change in recoveries minus the daily change in confirmed cases. And you'll see that when the line goes positive, they're out of the woods, okay? You'll see down here in the yellow bars with Italy, if I don't move my screen around, that this blue bar, the slope is getting better. The United States, it's a different story. We're continuing that downturn. Okay, so if we follow the pattern of other countries, we're hopeful. We're not through it yet. Probably another 30 or 60 days from what I've been reading, and we'll watch that trend. This is a fun graph, except it's going to be too hard to read here, so you can read it at your leisure. But you're going to see that the fall of the market has really followed the COVID-19 news cycle, and then the recovery up here is really following all the stimulus that the Fed and the government and the world banks and monetary policy around the world are throwing at this epidemic. So I apologize. I click on the slides and I keep moving around. So, but you can see that the market is following the news stories. This, of course, is a great map. You've probably seen this on the internet, but we threw it in there for your edification. Okay, so the markets. Are you confused yet? You should be, because last week was the best week since 2008, illustrated by the top chart. And it's also been the worst month since 1938, illustrated by the down chart. So it's interesting that you can have one of the best market weeks ever. At the same time, you're having one of the worst months ever. And of course, these prior two reference points of 2008 and 1938 were recession years. So there's a lot of debate whether we're in a recession yet or not. We are expecting the next 2 quarters of GDP to be down considerably. And we hope that we'll recover after that. We don't know if it'll be a V-shaped or a U-shaped recovery yet. We still have to look for the data. It'll really depend on when we get back to work and when the shutdowns are ending. So again, the market has been confused. It's been up, it's been down, and it's really based on the news of the COVID-19 cases and then the counterbalance to what the government is announcing on the stimulus. Okay, so what have we done? We removed our short position. So we had been shorting the market, meaning we make money when the market goes down. We removed that and moved it to cash. And we did that because the market's up and down so fast. It's up 4 or 5% one day, down 4 or 5% the next day. And so in that type of market, we decided to, instead of taking advantage of the short position, we moved that to cash. We also repositioned the portfolio to play more defense, okay? And then we continue to adjust as the facts are being unfolding. So the focus growth, we added cash. It went to 70% cash. And so we added a little higher growth prospect to that. So we trimmed some names in the portfolio and added cash. The focus dividend remains invested. But we did rebalance it. We increased some positions and took advantage of the markets to reposition for a better rebound. In the focused dividend portfolio, a lot of companies may be reducing their dividends, so we're paying attention to that. That would be expected in this market to see companies either reduce or temporarily reduce their dividend. But again, long term, we will keep that in cash and ride that through. So on the up days, you're going to participate. On the down days, you're going to participate. With the focused growth, you're not participating very much on the down days, and you're not going to participate very much on the up days. Okay, so we're giving up some of the upside because we're tilted to being more conservative on the down days. On the asset allocation, we are removing the short positions there, and we've also increased or diversified the equity. We left the equity percentage the same, but we diversified it for a rebound, and then we increased the short-term bonds. For the focused bond portfolio, it remains invested. We look to upgrade the quality, except the markets have been in chaos and it's been very hard to trade, and we couldn't get the liquidity that we needed to trade the bonds. So we've held that portfolio as is. It is still positioned to do very, very well. And it's an individual bond portfolio, so you can hold those bonds to maturity. The focused real estate portfolio, we did add to cash, so it's 60% invested and it has 40% cash. So that's some of the adjustments that we've done, and we'll continue to do so. Here's a fun chart comparing this episode with 2008. You can see the black line is the current market, and it's tracking 2008 very well. So if you follow this chart, we might think that instead of going straight back up, we might see a little sideways trading. We might see this pattern continue as we get more clarity, and then hopefully a recovery. So that's a fun historical fact to see how we've been tracking 2008. Again, I don't think we're quite at the market bottom. I think we will trade sideways, but we'll pay attention to the data and we'll update you as our views change. Okay, something interesting has happened over the last several weeks. Is in the past, there's been an inverse correlation or a negative correlation between stocks and bonds. However, over this last month, everything decided to fall. So gold, bonds, and stocks, as you can see here, all went down. Now the stocks went down big, and the bonds and the gold, which you would normally think would be going up, went down. And the reason is that there was a liquidity call. People were getting out of gold and bonds, and they were moving to cash. And we'll show you that on the next chart. So nothing was safe enough last month except for cash. And so typically we would have seen gold and bonds do a little bit better. They have recovered, but they weren't immune from this episode, and they did go down. So that was an unexpected move in the portfolios. You can see here that gold, cash, and treasury bonds, again, the same thing. The cash here, you can barely see if you blow your screen up. There's a little red line. It's basically stayed flat. And that's the reason that people have gone to cash, is that every other asset class has had volatility exposed to it. And so the safest place to go has been cash. Here we show the Treasury inflation-proofed, or TIPS, the Treasury inflation-proofed securities that track inflation. And you can see that gold is tracking very well. Remember, gold is a store of value. Gold will do well if inflation comes. So with all of this stimulus that we're now seeing, okay, even though we're going to have deflation or maybe a couple quarters of negative GDP, there's a strong chance that we see inflation on the backside of this recovery. And so if so, gold should produce a good return trying to combat that inflation. The fear and greed chart we showed you last time, the nice thing here is we're seeing some recovery. Okay, so here, last time we shot this video, we were down here. Fear was at the almost at the bottom, and you can see that it's really recovered well. It's recovering well as the market's recovering. If this red line turns green, that would be a buy signal. Okay, so we're not quite there yet. Okay, we could be testing the bottom with a dead cat bounce, but if this red indicator gets above that line on the fear and greed indicator, this would be a positive signal. So it's not quite there yet, but I just wanted to show you the change from last time that we shot this video for you. Okay, the fear index. This is the VIX. This is what people use to pay attention to the fear in the market. So right now it's very high, but it's coming down. Okay, and what this means, the simple fact for you is at this level, this means that we expect the market to move 4 or 5% per day. Now, we don't know if that's up or down, right? And so we've seen evidence of that. So the math on the VIX is showing right now that we're expecting a 4 or 5% move either way on a given day. That's a lot of volatility. Okay, so you can see the volatility chart here. I apologize, I keep moving these graphs around. Okay, so we've been no volatility, and then we get this violent volatility. Okay, and these are these 4 or 5% move days that we're expecting as indicated by the VIX index. Now, we can also look into the future by looking at the futures contracts, pardon the pun, and this is the market's future expectation of where the VIX might be. So you'll see here by August 20th, the market is expecting the VIX to be about 31.5. So at 31.5, that is expecting about a 2% move up and down. Okay, a normal volatility of around 15 gives you that 1% expected return up or down. So that just puts a little puts it in respect or in perspective for you that the VIX is high, expecting 4 or 5% moves per day. By August, we're expecting 2% moves per day. We don't quite have on our radar a normal volatility, but it will appear. Another thing that was very interesting was the unemployment numbers last week. So the market has everything baked in, right? Has all this bad news baked in. And we saw this record spike in jobless claims. And one would think that the market would go down on such bad news. However, it went up because it was less bad than was expected, right? So that's hard to understand. Bad news is good and good news is bad. So here, the jobless claims went up to over 3 million, but the market was resilient. It had it baked in. And this is the interesting part of all of this is, does the market have the 20% expected negative quarter in? Okay, so if it does, and the quarter comes back at negative 15 or negative 18, the market could go up. So even when we hear this bad news, when this bad news is eventually broadcast, the market could still go up if it already has it priced in. And so this will be something interesting to see. But the market did go up on the day that we announced that the jobless claims were at record highs. So that's an interesting turn in the market. The Fed balance sheet, again, here's 2008 and what they did with the balance sheet. Here's our balance sheet now. So everyone's been hearing about the stimulus. They're doing everything they can. They fired the bazooka. They dropped the bomb. They are putting liquidity into the system and bloating their balance sheet. So you want to follow the Fed. Here we can see that they're now buying ETFs. They're buying, they're buying all kinds of assets. They might even be buying equities. And so, we got to watch what they're doing, and they're definitely bloating their balance sheet. They're using all of their tools. They're using commercial paper, the primary markets, asset-backed, mortgage-backed, lending. So you can see all of these charts here, all these graphs are showing that the Fed is throwing the kitchen sink at providing this liquidity to the market to help us get through this episode, okay? So we're going to follow the Fed. On the presidential, you always got to throw some fun facts in. So for the U.S. presidential candidates, according to Predict, it looks like Trump is doing well through this COVID-19. So you can see that Biden was down. He really spiked. He's leveling off. You can see that Sanders had spiked and then has really tailed off here. So right now, as the data it appears that the markets, at least, again, it's not a political statement, but the markets right now are looking like Trump would have a second term. What should you do? Okay, well, again, keep your long-term perspective. Are you long-term or short? We think this is a great buying opportunity for the long term, but the short term is still going to be pretty bumpy. A recession and how severe that will be is to be determined. So just reassess your risk on, risk off. Make sure you have your financial plan in order. 70% right now probably want to buy and 30% are wanting to sell. And so we get this live data from all of our clients. And in the beginning, it was sell, then it was 50-50, then it was buy, and then it was sell. And now we're back to a 70% of us are probably wanting to buy and 30% are wanting to sell. And that evidence is confirmed with that fear and greed chart where we saw that the red bar is coming up and the fear in the market is probably gone. I put a paper out a couple weeks ago or so on the cycles of the bear market. And so we're probably through the major panic. The market is forward-looking and not backward-looking. So we're probably through the worst of the panic. Reposition portfolios from annuities to equities. So for a lot of you that have had fixed index annuities, it's been a great place to be over the last 5 years. And they were designed not to drop when the market fell. And we'll be shooting a video on that for you as well. But it'd be a good time to look at rotating from those very safe, secure assets and maybe putting some more money into the market over the next several months. Again, if you're withdrawing money regularly, Make sure you have a couple years or a year or two of cash or whatever makes you comfortable, so that you don't have to worry about the ups and downs in the market. So hopefully I did it. Give us any calls with questions. That was hopefully 10 minutes for you. We appreciate you as clients. Give us a call if you have any questions. Thank you.